Some people want to make peace, others want to make love, but investors want only one thing. They want to make money. The word quant has become synonymous with those computational wizards building trading strategies and other models for hedge funds. They make big profits by predicting price movements in stocks and bonds, just a little bit more accurately and a little bit faster than the other guys. Commodities represent another big financial market, where traders buy and sell the basic stuff that keeps the world running: grains, metals, energy, and more. There is large-scale trading in everything from pork bellies to frozen concentrated orange juice. And where there is trading, you can bet there are quants building models in order to get an edge. Oil is the liquid that makes the world go round. It is literally the energy source powering the economy. The price of oil affects everything else that is bought and sold. How can we accurately predict the future price of oil? Gold is the stuff that money was made of for most of human history. It retains a place as a store of value and a hedge against inflation. But how accurately can we predict the future price of this most precious of metals? Hi, I'm your host, Stephen Skeena. Welcome to the Quant Shop, where we use mathematical analysis and computational modeling to help predict the future. We're the Quant Shop, and we're open for business.
Guys, I just got a mail from Professor Skeena.
Okay.
So our project is predicting oil and gold prices in December.
Wow, really?
Wow. That's good.
That's a great one.
Yeah. It's nice, right?
Why is sad?
I'm not sad, I'm just happy I didn't get the Miss Universe project.
You know, when I just came to this country, I hosted my first job as a garbage man, because my father is a super for a building. So in order to assist him, I decided to, do some handiwork for him. So the thing I learned for serving as a garbage person is to categorize, different garbages, something recyclable, something unrecyclable, and I need to distinguish, bottles, papers, and metals, so on and so forth. That's a lot of fun.
So why are you taking data science?
Oh, data science. Okay, so when I was the undergraduate student here, I took one classes taught by Dr. Skeena, which is the algorithm. So I found that Dr. Skeena was very, a great professor. So I decided to take one more class in my graduate studies under him. Then I used to intern in JP Morgan Chase this summer. So I would like to learn more about data, because data is critical for a financial firm.
It's a perfect combination of mathematics, analytics, and algorithms, and used to solve practical problems.
We couldn't really be the Quant Shop without making a go at the financial markets. Therefore, we're going to try to build models for two of the world's most famous traded commodities, oil and gold. Commodity pricing is a particularly challenging area for investors of all stripes. It might seem like simple supply and demand in action, but commodity prices can change suddenly and dramatically in response to world events, including unusual weather patterns and sudden storms, the outbreak of war halfway around the world, and currency fluctuations. An old joke states that the best way to make a small fortune investing in commodities is to start with a big fortune. It's a tough business. This group is going to have to wrestle with the distinction between technical and fundamental analysis, or to put it another way, between data-driven models and theory-driven models. In technical analysis, investors or their algorithms look for signals in the up and down history of price movements in order to try to predict what the future price will be. There's enough commodity price data out there to train and evaluate models that will predict future prices on the basis of past observations. In contrast, fundamental analysis relies on economic, political, and scientific principles. How should the price of gold change as a function of currency exchange rates? How should the price of oil change during an unusually warm winter or in response to political unrest in the Middle East? Both ways of thinking have their role here, but I bet one approach is going to trump the other on this project.
So what do you think is interesting about your challenge domain?
Our team's challenge domain is to predict crude oil price and the gold price on December 1st this year, and also 1 month ahead and 2 months ahead of this date. So let me talk briefly about crude oil price first. From my understanding, the crude oil price is very sensitive to the global economic and geopolitical events. And I'm kind of person who is really interested in global news. Like in the year 2003, I heard something like, because of the war on Iraq, the oil price was increased by a certain percentage, while OPEC was trying to control the price and made it stable. Similarly, in today, with the conflicts in Eastern Ukraine, Syria, and Islamic State, etc., they have also affected the crude oil price. This task would help us to understand more about how those events would affect the oil price and how we can model these events. Then let me talk about predicting gold price. I personally know little about predicting gold price. I would say gold has become a very precious metal in our human history. People tend to use gold as a currency. Gold is still very important in our life. How gold is transacted and what organization, or I say organizations, control the gold price. What exact factors would contribute to the fluctuation of gold price and something behind that. Those are things I really don't know, and those are the things really interest me a lot. So I think I need to do some more research on that and know more about gold price.
Do you think you will be able to build an effective predictive model? Why or why not?
Okay, let me break down this into two parts. But in general, I can give you the answer. Sure, I do. If we are talking about purely data-driven models, which are predicting the oil and the gold price purely based on previous price data, I would say we can build effective models on this principle, because our domain challenge is not really challenging. You know, we are predicting the price on December 1st this year rather than December 1st, 2024, which is 10 years from now. But if we try to approach from a first principle view, which means we need to model the price based on some or all possible factors affecting the price, I would say it's going to be really challenging. Firstly, we need to know exactly how many factors would affect oil or gold price, and then how much weight we should assign to each of these factors, and how we consider the intercorrelation between those factors.
There are the different models for predicting gold and oil price. A lot of work has been done in this domain, and a variety of mathematical tools have been applied to solve these problems. So we have autoregressive models like ARC and GARC, semi-parametric approaches, qualitative econometric models, okay, and even quantitative econometric models as well. Like there's a paper by Huntington regarding that. So like a lot of various techniques have been applied to the problem, and like different degrees of accuracy have been achieved. So this is sort of like, this makes it really interesting.
We are trying to predict the prices of oil and gold. When it comes to monetary time series, it's actually very important to adjust the prices for inflation. And how inflation adjustment's done is we divide the time series by, say, a price index. For example, we've taken the consumer price index. It's just an index which represents the price level relative to another year. Say the consumer price index in 2014 is 200, and say the CPI was 150 back in 2004, and a price of some commodity today is $100. What would have the price been in 2004? So the price is divided by the CPI of this year and multiplied by the CPI of the year we want to calculate. So a typical commodity which costs $100 today would have costed $75 back in 2004. So let's see how much this has affected our predictions and our models. This is a comparison of the correlation between various factors with and without inflation adjustment. So initially we didn't bother to adjust for inflation, and let's see the difference it has made. This is what is important to us. Initially we noticed without inflation adjustment that there was a very high correlation between all the factors we considered, like 0.7, 0.77, 0.87. But when we reduced for inflation, the correlation actually reduced a lot. So take for example a gold and NYSE, the New York Stock Exchange. The correlation was 0.6 before inflation adjustment, and it's 0.17 now after inflation adjustment. So this is a huge indicator of how misleading these numbers are without inflation adjustment.
One thing that I think is important here is evaluation. Okay? How do you decide how well you're doing, and how better or worse does it get with more of a history? That would be one thing. But again, you've got 5 models there, and you're saying, one of them is better. Is it really better? Okay? I mean, again, you've got, we talked in here about p-values, and we talked here about, statistical significance testing, right? When you have, one thing I can guarantee you is that if you have 5 models predicting anything, one model is going to be more accurate than the other on a particular data set, right? You could use, one model could be him picking random numbers, second model could be him picking random numbers, the third model is going to be a winner. And the question is the winning by enough to be statistically significant? Seems like the kind of thing you would want to be looking at. There's one other, let's say, predictor that I want you guys to think about. You're using analyst predictions. There also are things called futures. Okay? There are ways that you can trade on what people think the price of oil is going to be. There are ways to buy oil, contracts you can sell and buy and sell on various commodity exchanges or futures markets that will tell you, we can say, what is the price of a gallon of oil, a barrel of oil going to be in December. Okay? And people can trade on this.
So I don't like there is data available of the future trading factors, as in how much of it will be traded.
Okay, again, you can buy. Right now, there are contracts you can buy. Again, you have to figure out how. We learn a little bit about how the financial markets work. But you can buy contracts on saying, I want to buy the right to pay $50 a barrel for oil in December. Now, how much should I pay for the right to buy a barrel of oil for $50 in December? Now, maybe you're saying, well, if the price is $80 now, if I pay $30 for that, that would be a fair deal. But if I think that the price of oil is going to go to $100, then that's a great deal, right? To be able to, to buy that price, to buy the oil at that price for only that plus the future contract price. Okay? And so there is a market that is trying to predict what the future price of oil is. And my claim is data from these futures prices encodes what traders think or know about the future. And my guess is this has a fair amount of predictive power. But how do you find out how much predictive power it has? You evaluate it.
We are collecting the monthly data of the gold and oil.
Okay.
So one of the data sets collects the first of every month, and another data set collects the last of every month. And we ran the data for 20 years, 30 years, 40 years, 30 years also. And we have error metrics and the prediction value predicted. So here we would like to discuss how our model, the baseline model, we like to compare that with our 0.2 model, which is the model which we interpreted based on the paper, PSO paper.
Okay. We'll talk about linear regression soon. You might want to try to fit your own regression model here.
We just took the coefficients, like I just played around with the coefficients and took these coefficients. And maybe I can do it better if I like make it 2 to the power k and 2 to the power k minus 1.
Well, the right thing to do is to use a regression.
Yeah, exactly.
Okay, this is what linear regression is for. You're trying to figure out a function as a linear function of previous terms. With a coefficient, the coefficients, if you do linear regression, it will learn the optimal coefficients.
Yeah. So we didn't do that because like we were just
Just for the baseline.
Yeah, for the baseline we just
okay. Well, but the lesson that's important here is your baseline is good, and these other models that seemed more complicated
are actually not so good.
are not obviously better. Even in the case where you said that it's a little bit better. Okay, so I would encourage you to use something like linear regression.
Okay.
And I would also say you've got to factor in more variables. Right now, you're just doing a technical analysis, what you would call in financial terms a technical analysis. It's basically looking at the past values of this curve and trying to predict the next function based on the values of that. Okay, and again, there's other things that happen to affect oil prices. If you want to try to build a more reasonable model, you probably need to include these other things in your model. Things like what the inflation rate, what are all those other phenomena?
Yeah.
The standard deviation is in some sense measuring the volatility that you're getting, right? And you probably want to try to put it into some perspective here. Again, I think what is good to hear is to see what the limitations of your method is. And now show what is the natural variation in these quantities measured by standard deviation over the past X window of time, and see how often future prices lie within how far of the standard deviation. Your prediction is now, if I'm to take your current prediction, a month from now the price is going to be the same as today. What would you say is the likely error range? Presumably what you're really saying is that there is going to be a probability distribution. It's going to be at any one of these prices. Now once you've got a mean and a standard deviation and some assumption about what your probability distribution is, now you've got a probability distribution. And you may want to ask yourself, how often does it stay in how tight a range of what you think it is? If the prices have been jumping around a lot lately, presumably you're less confident of your prediction it's going to be the same a month from now than if the prices have been very stable.
Yeah, okay.
So I would encourage you to look at these kind of things and try to profile them. Make sure you understand this issue of predicting. How accurately do the simple models do predicting just based on price history? The important thing is to learn what the confidence interval of your predictions are. And then see if more sophisticated models that involve other things maybe make these predictions with less error. Okay, they may not still know directionality very well, but maybe you can reduce the error term here.
Maybe if you use a linear regression as in that.
Okay, we'll try that, see what happens. Okay.
Or maybe,
Okay.
The price of crude oil depends on balance between supply and demand. Several factors affects the supply demand and cause fluctuation in the prices of the gold and oil. Some of the major factors that affects the price of oil as per our literature study are S&P 500 index, NYSE index, and US dollar index, and the gold price itself. And similarly, we did the literature study for gold, and we came to know the factors affecting our S&P 500 index, NYSE index, US dollar index, Euro USD exchange rate, consumer sentiment index, and oil price.
Now, commodity price prediction is in itself a relatively hard problem, and initially we were a little apprehensive about whether we will be able to solve the problem or not. But Professor Skeena advised us to start simple. Thus, we started with a simple model where the price remains constant, and we treated this model as a baseline model. Interestingly, this model didn't seem to do too bad. Then we tried other models like the one where the price is the weighted average of the past few days. Now, all these models performed a similar level of accuracy with the baseline. Realized that our problem is a very well researched problem, and a lot of work has been done in the academia related to this. Most of these prediction models for commodity price prediction lies in three broad categories. They are like the technical models where they use time series analysis techniques, or they are the structural models. It considers the economic factors, and then these models are basically just machine learning algorithms that are trained against the past time series for various attributes. And then like after training, this is used to predict the current price. And the third type of model are based on futures contract prices. But unfortunately, at first we found that these models performed worse than our baseline model. I mean, these structural models which took various economic factors into consideration. But then we realized this was basically due to a fault in our data set. We had failed to adjust our data set for inflation, and as a result there was a higher correlation between the factors than what should have been. But once we fixed the issue, the structural model started performing way better than the baseline, and we were happy about it. Our final futures model had errors almost half of our ARMA models for gold. All in all, we thought that this was a decent performance, since commodity price prediction is in itself hard, and it's a well-researched problem, and we were constrained on the amount of resource and information. And it seems that given that, we did a decently good job.
What does our future model says for the price of oil?
Okay, the futures model says that for the price of oil will 57.33
Okay, per barrel.
per barrel.
Okay, so what is the gold price going to be?
It says it's going to be about $1175.29 an ounce.
3, 2, 1. Happy New Year!
Okay, the price of oil is 53.27.
What was the prediction?
It was somewhere about 57.
It was 57.33.
Okay.
Oh,
That's
that's
good.
good.
That's good.
Yeah, that's better. Yeah, we're near.
53, that's good.
Yeah.
And for gold,
Very good.
for gold it is 1,183.90 per ounce.
What is that prediction?
What was the prediction?
1,070 something.
1,175.29.
So 1,175.29 was a prediction. I actually
1,883.
83.
$8 difference.
$8 difference, and
Yeah,
that's
good.
like,
Hey.
come on. There's 1,000.
So we've made our predictions, and so let's say how well our model performed, and how close predictions were to the actual value. So the price of oil on December 1st was about $69. It was a steep drop, and by the mid of December it fell down to about $56 a barrel. And on December 31st, the price was $54, and finally on December 31st, the markets closed at 53.27 a barrel, and our prediction was 57.33 a barrel. So looking at the prices in the past month, it may not seem that our model did a very good job, but our model actually predicted based on the past few months. So on September 30th, the price was about 90 a barrel. On October, it was about 80 a barrel, and in the end of November, it was about 65 a barrel. So considering that our model actually took into consideration these past values, I think our model did a fairly good job in making a prediction.
I think the project went really good. We learned a lot of important data science topics. First of all, we started with simple baseline models. We learned the importance of having a good baseline. Then we improved our model and we found we did a lot of literature review, and we found out about autoregressive models in ARMA and GARSH, and that was a good learning experience as well. It taught us about time series analysis. And finally, we looked at the economic factors. So it was a combination of a lot of things. We learned about time series analysis. We learned about a little about how the economics work, about all the economic factors. And then finally, we used the futures prices, which was it's in itself very interesting, because this futures model did better than the ARC and GARC models. So
this is an important lesson about your project,
Yeah.
is that you had all these data sciencey models, you try to look at the past time series
Exactly.
based on the shape of the time series, and that had big limitations, right?
Exactly.
You tried to factor in economic models, that still had big limitations.
Exactly.
But when you took into account a sort of the futures price, which is the money that's being bet on it, that did a much more valid prediction
Yeah,
than
exactly.
anything else you did.
Yeah,
There's
exactly.
a saying that the average dollar is smarter than the average person. Okay, so that if you look at where the money is being invested in, that probably tells you a lot more about what the opinions mean. So what were the kind of models that you ended up building?
We started off with the baseline model, which was very naive, and then we built a
Baseline model was just depending upon whether a time series was moving up and
Up
down
and
in the
down,
past,
that's it.
whether there's trends that are going to continue.
Yeah, that's it. And then we moved on to autoregressive models, and then we tried out ARMA. These are the pure autoregressive models, and we tried to incorporate some economic factors. So the regression was
Now you're including things like the stock price and
yeah,
dollar
the
price
stock
and other
exchange,
things.
you know, stock exchange, the dollar index.
And these models did a little bit better, but
They
still
were a
not
little
great.
bit better than the baseline, but not significantly better.
And so what did much better?
And what finally did better was the futures models. I mean, we never thought that it would do so much better, but we tried it out. It actually did twice or thrice better than the other regressive models.
Right. So there's some law of data modeling that I have is that simple models have predictive power,
Yes.
but they don't have predictive power when there's money on the line. Okay, and so when you have some kind of a measurement that is really measuring what investors are thinking
Yeah.
or knowledgeable people are thinking, things like a futures price, a stock price, or something like that, it captures a lot of information.
Yeah.
And so maybe one of the lessons here is that you can't try to outpredict what these financial variables are by doing basically data analysis of these kind of time series.
Yes.
There's a story about market efficiency that says that, if you believe that markets are efficient, then every publicly known variable about that can affect the stock price is sort of already encoded in the price.
Yes.
It says that you're not going to be able to do a better job of predicting one of these things based on analysis of public data like past prices and things like that.
Yeah.
And learning that kind of thing is a helpful investment lesson because there's a lot of crazies out there who are trying to draw pictures of time series and then say what they should be investing their life savings in. So one thing that was important with your project was the importance of assessment.
Yes.
That when you guys came to me at one point, you had a big, very complicated model. And unless you then took a look at it and saw how it compared to baselines and looked at it in a very rigorous way,
You would never have known how.
you wouldn't have known that the big complicated model wasn't doing any better. In fact, was doing worse, as I remember, than a simple model involving a small number of variables that were selected because of some representative reason. And that, I think, is an important lesson, okay, is that many people, when given a modeling job, try to make it very complicated, add as many variables as they can, think the regression is going to do magic for them. But it's often the case that what gets very good at predicting the small test set you have is going to be overfitting. And then you do a great job predicting the past, but when it comes to predicting the future, you're hopeless. Okay.
We have now understood that it is not possible to predict the price of gold or oil with a good level of accuracy. That is the perfect value we are not able to generate, and we would not be able to. Even the top financial firm who deal with the stock markets fail to make accurate prediction. One such example would be the recent drastic fall in the oil price, which no one had anticipated, and we came to know that is because some of the oil refineries which were shut in operation, they came back, which were in Africa and Middle East countries, and because of that the supply increased and price of oil decreased. There is no one perfect formula that computes the price of oil or gold.
The most interesting thing I've learned is probably how hard is it to actually make a decently accurate prediction. Despite there being so many machine learning techniques and so many economic theories, it's actually none of them are actually good enough to make accurate prediction.
Again, I'm not a licensed investment specialist, but if you ask me, for those at home, put your money in index funds, okay? And then you can sleep well at night, okay? So that concludes our foray into the financial markets. We've seen how analysis of data can help predict the price of commodities and other financial assets. Good luck to you on your investments. See you next time in the Quant Shop.
We are the quant shop. We are open for business.